Welcome to Theta Fuse. This is an emergency weekend deep dive.
Yeah, we had to get on the mics today. There was no waiting until Monday for this one.
No, because it is Saturday afternoon, February 28th, 2026.
Yeah.
Right now, traditional markets are closed. The opening bell doesn't ring for another 48 hours.
Right.
But the geopolitical landscape as we knew it yesterday at the close has just completely fractured.
Completely.
If you are listening to this right now, you are already ahead of the vast majority of retail traders because they're going to wake up on Monday morning, look at their portfolios, see just a sea of red, and make highly emotional, destructive decisions.
Which is exactly how accounts get blown up.
Exactly. So our mission today is to make sure you are not one of them. We are taking the breaking news from Bloomberg, the live reporting from Fox News, pulling the market data from Yahoo Finance, and we're synthesizing it.
We have to project exactly what is going to happen when the bell rings on Monday, March 2nd.
And more importantly, formulate a definitive trading game plan to actually capitalize on the massive incoming volatility.
The institutional desks, they are not waiting for Monday. I can promise you that.
Oh, absolutely not.
They are scrambling right now. They're running their weekend risk models. They're adjusting all their algorithmic parameters, preparing for a massive repricing of global risk. We need to be doing the exact same thing.
Right.
Because when the VIX gaps up aggressively and the data we have guarantees it creates a graveyard for traders who let panic take the wheel. But for options traders who understand implied volatility, who know how to strategically sell premium.
Generational opportunities.
Exactly. Incredible opportunities. We have a massive stack of data to get through today, and our goal is to connect these macro events directly to your trading terminal.
But before we dig into the specifics of what actually happened overnight,
Yeah.
I want to enforce a very strict rule for this deep dive.
Yeah, this is important.
We're going to be discussing some highly charged, deeply polarizing political and military actions. We have quotes from U.S. leadership, Israeli leadership, Iranian leadership. We even have executive actions regarding domestic tech.
And this is absolutely critical for you to internalize right now.
Yeah.
Here at Theta Fuse, we do not take political sides, ever.
Never.
We are options traders. The market does not care about your personal geopolitics. It doesn't care about your ideology or how you vote.
The market is just a cold calculating machine.
Right. It prices in risk, it prices in supply chain disruptions and capital flows. That's it. So we will impartially report on the statements and the actions in these sources solely to analyze how these events will dictate market mechanics on Monday morning.
You have to leave your political biases at the door today, because letting bias drive your trades will only cost you money.
Our only loyalty is to the tape and the mathematics of options pricing.
Well said. So let's set the stage. Let's look at where we were before the bomb started dropping, because context is everything in trading.
Always.
I was pulling up the Bloomberg terminal data from Friday's close, and the tape was already incredibly weak.
It was bleeding before any of this breaking news hit the wire.
Right. The S&P 500 closed down 0.43% at 6,878.88. The Dow Jones took a really heavy hit, dropping over 521 points to close down 1.05% at 48,977.92.
And tech wasn't safe either.
No, the Nasdaq shed almost a full percent, dropping 210 points to 22,668.21. But then there's the Russell 2000.
Yeah, the Russell got destroyed.
Just absolutely hammered.
Yeah.
Our small cap gauge closed down 1.68% at 2,632.36. I look at those numbers and I have to ask, was the smart money already front-running this weekend?
I mean, if we connect that Friday tape to the bigger picture, it tells a very specific, undeniable story. Institutional money was actively de-risking.
They're taking chips off the table.
Taking chips off the table heading into the weekend because small caps, like the Russell, they usually bleed the fastest in a liquidity crunch.
Right, because they carry higher debt loads.
Exactly. They lack the fortress balance sheets of your mega caps, which explains why the Russell took the hardest hit. The whispers of a military buildup in the Middle East were already circulating on Friday.
Yeah, the rumors were there.
And institutional risk managers, they do not hold heavy, leveraged long positions into a weekend where a geopolitical powder keg is just sitting next to a match. They essentially sold the rumor. They priced in a potential escalation.
But what actually materialized on Saturday morning was significantly larger, more brazen, and way more escalatory than anyone had priced in at 4:00 p.m. on Friday.
Not even close.
And that delta, that gap between what was expected and the shocking reality of what is currently happening, that is exactly what we have to trade on Monday.
Right.
So let's get into the reality of the weekend shock. Saturday morning, daylight broke in the Middle East, And the United States and Israel launched a massive coordinated military offensive against the Islamic Republic of Iran.
Coordinated and massive.
According to the Fox News reporting, the Israeli side of the mission is dubbed Operation Roaring Lion, and the U.S. military component is named Operation Epic Fury. And we are talking about massive daylight strikes here.
Yeah, this wasn't some stealthy midnight operation designed to minimize optics or, slip under the radar.
Not at all. And that daylight aspect is a massive data point for the market to absorb, isn't it?
It is huge. In military posturing, a daylight strike signals a profound level of brazenness. It signals confidence. It tells the market that the attacking forces have essentially achieved air supremacy, and they just aren't deterred by the threat of immediate anti-aircraft reprisal.
Right.
But more importantly, for our Monday open, it signals to the algorithmic trading bots and the human risk managers that de-escalation is not on the immediate horizon. The scope of this is just staggering.
When we look at the targets, the Fox News reporting indicates the opening wave struck a compound associated directly with Supreme Leader Ayatollah Ali Khamenei.
They went right for the top.
Right for the top. They also targeted widespread military infrastructure, ballistic missile sites, launchers spread all across western Iran.
And there is a very specific name mentioned in the intelligence assessments that are circulating right now.
Yes. Local reports indicate that Ali Shamkhani, who's a senior advisor to Khamenei and a deeply key figure linked to Iran's nuclear program, was likely killed in the operation.
Now, to be clear, the military hasn't formally confirmed the specific individuals targeted yet. Bomb damage assessments are still ongoing.
Right, it's early.
But that is the intel driving the weekend narrative. This isn't just hitting some empty runway in the desert. This is striking at the very top of the command structure.
Which brings us to the core reason why this specific event is going to completely terrify the equities market on Monday.
Because the market, historically, it can digest a surgical one-off strike.
Sure. If a single military target is hit, the market briefly panics. It prices in the isolated event, the VIX spikes, and then it immediately crushes, and equities recover.
But that is fundamentally not what is happening here. A U.S. official confirmed directly to Fox News that these strikes are expected to last for days, not hours.
Days.
Let that sink in for a moment. Days. This means that when the opening bell rings on Monday morning, this military operation will still be highly active.
The bombs will literally still be dropping.
The situation will be incredibly fluid.
And I just can't stress how disruptive that is for a trader trying to find a bottom on Monday. You cannot catch a falling knife when the news cycle is actively resetting every single hour with new strike reports.
You'll get chopped to pieces.
Exactly. And the preparations on the ground completely confirm this prolonged, multi-day timeline. Israel's defense minister didn't just heighten alert levels. He declared a special and immediate state of emergency across the entire country.
And they called up approximately 70,000 reservists.
70,000.
That's a massive mobilization. These troops are largely being mobilized for aerial defense, border reinforcement, home front command duties. You absolutely do not mobilize 70,000 reservists and lock down an entire nation for an operation that you expect to just wrap up by Sunday dinner.
You certainly don't. And the Iranian response confirms that this is a rapidly escalating feedback loop.
Yeah, they are already firing back.
The IDF has already reported that incoming retaliatory fire from Iran amounted to, and I quote, more in the dozens per round in terms of ballistic missile barrages.
So let's step back and look at the board here.
Okay.
We have a binary, actively escalating, multi-day conventional conflict involving major global powers taking place in the absolute most critical energy-producing choke point on the planet.
Right.
I cannot overstate this basic truth of trading. The market aggressively hates uncertainty.
It hates it.
It hates not knowing what the Fed's terminal rate will be. It hates not knowing next quarter's earnings guidance. And it fiercely, violently hates not knowing if a regional war is going to choke off the global energy supply for the next 6 months.
And the rhetoric driving this uncertainty guarantees that we're not going to see any immediate diplomatic off-ramp.
There is no off-ramp right now.
Let's look at the statements from world leaders, because these words are quite literally what algorithmic trading programs are scraping and analyzing right now to set pre-market futures pricing.
Right. The algos read the news too.
President Trump posted a video message to Truth Social, confirming the U.S. involvement in what he specifically called major combat operations.
Major combat operations.
He stated that it has always been the policy of the U.S., and his administration in particular, that the Iranian regime can never have a nuclear weapon.
And the exact phrasing in that video is critical for us to analyze. He didn't just announce a military objective. He urged the Iranian regime to lay down its weapons or face certain death.
Face certain death.
And he went a step further, urging the Iranian people to take over your government.
Right.
Now, from a purely analytical market mechanics standpoint, this is regime change rhetoric. It completely prices out any possibility of a swift ceasefire negotiation or a diplomatic de-escalation over the weekend.
The market prices in probability.
Mm.
And the probability of a peaceful Monday just went to zero.
Absolute zero.
On the other side of the conflict, the Iranian Foreign Ministry released a statement blasting what they call the criminal military aggression by the United States and the Zionist regime.
Right.
But more critically for the global markets, Iranian Foreign Minister Abbas Araki stated that Iran's response would be to target all U.S. military bases in the region.
All of them.
And we aren't just waiting to see if that's a bluff. We are already seeing reports from Al Jazeera, citing Iran's Fars news agency, of blasts occurring across several Gulf states that host vital U.S. military assets, specifically Qatar and Bahrain.
Now, a U.S. official did tell Fox News that there were no casualties in Bahrain, as the strike apparently hit an empty warehouse.
Thankfully.
But the geographic spread of these retaliations is massive.
It's widening the map.
Which raises a vital point about how we have to approach the opening bell. The combination of this regime change rhetoric and the physical reality of widespread multi-nation missile strikes means the VIX is going to explode upward.
The volatility index.
Yes. Implied volatility across the entire options chain, from massive index ETFs down to individual tech stocks, will be historically bloated.
Because when the VIX gaps up like that, pure panic is setting the price of options.
Exactly. Retail traders are going to log into their brokerages, they're going to see the futures tape bleeding out, and they are going to scramble to buy put options to protect their portfolios.
And because they are panicked, they are going to pay exorbitant, mathematically unjustifiable premiums to market makers to get that protection.
We, as disciplined volatility traders, have to step back. We look at this rhetoric impartially and recognize it for what it is. It is fuel for an IV expansion event.
Which brings us perfectly to the only market where we can actually see this panic pricing in real time.
The weekend pressure valve.
Exactly. Because while the traditional equities markets in New York and London are closed, there is one major market that trades 24 hours a day, 7 days a week, 365 days a year.
Crypto.
Crypto. When a massive geopolitical shock hits on a Saturday, the crypto market becomes our weekend pressure valve. It is the absolute best canary in the coal mine for projecting what traditional equities, specifically high beta tech stocks, are going to do on Monday.
It is quite literally the only real-time gauge of global liquidity and risk appetite we have functioning right now.
And the signal it is flashing is aggressively, violently risk-off.
Yeah, let's look at the Bloomberg data on this. The absolute second the news of the strikes broke, Bitcoin and the broader cryptocurrency market fell off a cliff.
Just a straight line down.
Bitcoin slid below $64,000. It dropped as much as 3.8% to hit $63,038 before finding a slight stabilization around the 64K mark as of 6 a.m. in New York.
And Ether wasn't any better.
No, Ether, the second largest token by market cap, slid 4.5% down to $1,836.
So in the immediate aftermath of the news breaking, roughly $128 billion in market value was erased across digital assets, according to CoinGecko.
You have to pause and respect the sheer scale of that number.
$128 billion.
$128 billion of theoretical value evaporated in a matter of hours on a Saturday morning while the rest of the financial world was drinking their coffee.
It's what?
This isn't retail traders on their phones selling a few fractions of a Bitcoin. This is institutional algorithmic de-risking.
The bots took over.
This is automated risk management software, seeing the news headlines, calculating the geopolitical risk premium, and dumping long-duration, high-risk assets at market price. We need to look under the hood at the tape to understand the exact mechanics of this sell-off.
Yeah, because the data from CryptoQuant is incredibly revealing here. I was looking at that CryptoQuant analysis, and it shows a structural earthquake.
A massive, sharp increase in selling pressure.
Specifically on Bitcoin derivatives. Within a single hour on Saturday morning, sell volume surged by approximately $1.8 billion.
Think about the mechanics of an order book for a moment. An imbalance of $1.8 billion in sell volume hitting the biz in a single hour on a weekend. That is going to absolutely shred through liquidity.
Let's look at how the analysts are interpreting this flow. Selene Olive, a noted crypto analyst, wrote that this massive imbalance reflects clear seller dominance and rising short-term risk aversion.
Right.
He pointed out that these specific flows are being driven entirely by emotion, fear, and automated risk management, rather than by any fundamental structural dynamic in the crypto network itself.
This is the textbook definition of a panic flush. People aren't selling because the asset has fundamentally changed. The Bitcoin network is exactly the same as it was on Friday.
Exactly.
They are selling because they need to move to cash.
But there is a counter perspective in the sources here that I want to push on because it might give us a clue about Monday's bottom.
Okay, let's hear it.
Justin Denethan, the head of research at Arctic Digital, he noted that the initial impact on Bitcoin actually wasn't as catastrophic as some might have expected given the severity of the military news.
Interesting.
He said, as always, when critical events take place during the weekend, Bitcoin plays the role of pressure valve. But then he added something really crucial. He said, with a lot of the leverage already cleared out and exhausted sellers, there's only so much impact macro events can have. Not to say Bitcoin cannot go lower, just that a lot of the volatility has already been flushed out.
See, that is a brilliant nuance from Denethan, and it requires us to understand how margin works in crypto versus traditional equities.
Walk us through that.
When he talks about leverage being cleared out, he's referring to the cascading liquidations of leveraged long positions. In the crypto derivatives market, traders routinely use 10x, 20x, even 50x margin.
Which is insane, by the way.
It's pure gambling. But when a geopolitical shock hits and the spot price drops suddenly, the exchanges step in and force liquidate those leveraged long positions. They literally take the trader's collateral and sell the asset at whatever the market price is to cover the loan.
And that forced selling drives the price down even further.
Exactly, which triggers the next guy's margin call, forcing another liquidation, and so on. It's a cascade.
A domino effect.
So if Denethan is right, and that leverage has already been violently flushed out by this 1.8 billion sell wave, it means the forced mechanical selling might be over.
Right.
The weak hands have been broken.
What remains are the emotional spot sellers.
Yeah.
Which means the extreme velocity of the downward move might be capped.
Right.
Okay, so let's translate this weekend crypto action into actionable intelligence for Monday. What does this mean for you, the listener, heading into the equities open?
It means Bitcoin has done us a massive, massive favor.
It has front-run the panic.
Yes.
Because Bitcoin is highly correlated with risk-on, long-duration traditional assets, specifically the NASDAQ and high-growth tech stocks. This weekend bleed is a direct, undeniable preview of Monday morning.
Undeniable.
You should expect extreme, emotionally driven selling pressure on tech and growth stocks the absolute second the opening bell rings.
Why? Because the people who are holding leveraged long positions in the traditional equities market haven't been able to sell yet.
They're locked out.
They are trapped in their positions all weekend. They are sitting on their couches right now, watching the news out of the Middle East, watching Bitcoin bleed out on their second monitor, and they are stewing in absolute panic.
When 9:30 a.m. Eastern hits on Monday, they are going to mash the sell at market button to stop the pain.
Which is precisely what we want them to do.
Because as premium sellers, we are going to be waiting on the other side of those panicked market order trades to collect their heavily inflated options premium.
Right. But before we get to the specific Theta Fuse options strategy, we have to follow the money. Capital doesn't just evaporate into the ether.
It rotates.
It rotates. In scenarios of unpredictable, escalating geopolitical conflict, especially one centered in the Middle East, institutional capital flees from risk-on growth assets and aggressively rotates into physical, safe haven assets and commodities.
Which brings us to where the institutional money is going to hide on Monday. Let's talk about the safe haven and energy play.
This is crucial.
Susanna Streeter, the chief investment strategist at Wealth Club, put out a note on Saturday that perfectly encapsulates the institutional mindset right now.
What did she say?
She said, while risks of conflict erupting again were bubbling, given the U.S. troop buildup in the Gulf, hopes had been pinned on fresh negotiations, and the decisive military action came sooner than expected.
It caught them off guard.
It did. She then laid out the exact rotation we are going to see. We are set to see another pile-on into assets perceived as safe havens, such as gold, as investors look to shelter their money, given the course of the conflict is so unpredictable.
And right there is your first actionable directional insight for Monday. Expect a massive gap up and a sustained institutional rotation into physical gold trusts and ETFs like GLD or IAU.
Because gold is the oldest, most deeply ingrained psychological safe haven in human history.
It has zero counterparty risk. It doesn't rely on a tech company's earnings report, and it can't be downgraded by a credit agency. When the geopolitical world feels like it's burning, central banks and institutions buy gold.
So if you are looking for a straightforward, directional momentum play on Monday, the physical asset space is where the capital inflows will be concentrated.
Absolutely.
But while gold is the safe harbor, the real powder keg here, the market that is going to experience the most violent, explosive repricing is energy.
Oh, yeah. Energy's going to be wild.
We have to break down the dire logistical situation in the oil markets using the Bloomberg supply data. Iran is a massive, critical player in global energy. Despite years of intense international sanctions, the data shows they are currently producing roughly 3.3 million barrels of oil a day.
That is huge volume.
That is up significantly from less than 2 million barrels a day back in 2020.
Yeah.
They are pumping massive volume.
And here is the critical vulnerability that the market's going to price in, their export infrastructure.
Right.
Iran has become highly adept at skirting international restrictions. They send about 90% of those exports directly to China.
Usually using what the industry calls a dark fleet.
Exactly. Aging tankers that sail with their AIS transponders completely deactivated to avoid satellite tracking. But regardless of whether a tanker is dark or broadcasting, almost all of that physical oil has to flow through very specific, highly vulnerable geographic choke points.
The Karg Island terminal.
The Karg Island terminal handles a staggering 90% of Iran's crude exports. It is the beating heart of their energy economy, and it has a storage capacity of roughly 28 million barrels.
So if the U.S. or Israel decides to target energy infrastructure in the coming days as this multi-day operation continues, Karg Island is the absolute bullseye.
It's the primary target.
And the geography of the broader region creates an even bigger macro nightmare that extends far beyond just Iranian oil. I'm talking about the Strait of Hormuz.
The ultimate bottleneck.
Iran sits directly on one side of this incredibly narrow shipping lane. The Strait of Hormuz handles about a fifth, a full 20% of the entire world's crude oil supply.
We are talking about vital global suppliers like Saudi Arabia, the UAE, and Iraq relying on this waterway to get their product to the global market.
And the Bloomberg data shows that right now, as we speak on Saturday, tankers are already actively avoiding the area. Massive commercial ships are piling up on either side of the entrance.
They're terrified.
Their captains and insurance underwriters are completely afraid to sail through the strait following the opening salvos of Operation Epic Fury.
And if we connect this logistical bottleneck to the broader macroeconomic picture, a disruption in the Strait of Hormuz is the ultimate nightmare scenario for global inflation.
Because it doesn't just affect Iranian oil.
No, it chokes off the global supply at the source. Think about the logistics. When 20% of the world's oil is suddenly at risk of being tracked, or when maritime insurance premiums skyrocket so high that shipping companies refuse to transit, the price of crude doesn't just tick up a few percentage points.
It explodes.
Now, the physical oil and futures markets are closed for the weekend, so there is no initial price discovery happening right this second. But you can virtually guarantee that Brent and WTI crude futures are going to gap up violently the moment the electronic trading sessions open on Sunday night.
So how do we translate this massive macro supply chain nightmare into an actionable Theta Fuse options strategy? With the Strait of Hormuz and Iranian supply in direct focus, the energy markets are going to go absolutely wild. If I know oil is going to spike, why wouldn't I just buy aggressive call options on energy ETFs?
Okay, for our advanced listeners or those running automated high-frequency strategies, the volatility in leveraged natural gas and oil ETFs is going to present historic trading ranges on Monday.
We're talking about tickers like BUYLL.
Right. BUYLL, the ProShares Ultra Bloomberg Natural Gas, and KOLD, the Ultra Short Natural Gas ETF, or UCO and SKO for leveraged crude oil. But you have to understand the underlying mechanics of these instruments.
Right, and we have to issue a massive warning on those leveraged ETFs. They suffer from two silent killers, beta slippage and contango decay.
These are not buy and hold investments that you park in your retirement account.
Exactly. These leveraged funds are purely day trading vehicles meant to capture massive intraday swings. They don't hold physical barrels of oil. They hold rolling futures contracts.
And when the futures curve is in contango, meaning the future months are priced higher than the current month, the fund constantly loses money every time it has to roll its contracts forward.
Over time, that decay will eat your capital alive, even if you are right about the long-term direction of oil.
Furthermore, with the VIX heavily elevated on Monday, the implied volatility on the options for these leveraged ETFs is going to feature staggering, historically expensive premiums.
The market makers know exactly how wide the implied moves will be.
And they will price the options accordingly. If you are going to play the energy volatility using these instruments, you must size your positions with extreme caution. A 10% move in the underlying crude oil commodity translates to a 20% or 30% violent swing in these leverage funds.
The energy sector is going to be the absolute epicenter of the Monday market earthquake.
But here's where it gets really interesting.
Because just when you think the market has enough to digest a multi-day Middle Eastern war, a global energy supply shock, and a massive flight to safety, a completely separate, massive domestic curveball hits the tape at the exact same time.
Let's look at the tech wildcard.
The software and artificial intelligence sector just got hit with an unprecedented level of government policy risk, right as the international landscape fractured.
This is what risk managers call a textbook black swan cluster.
A cluster.
The market was already guaranteed to sell off tech heavily on Monday based on the macro risk-off sentiment and the rising oil prices, which traditionally act as a tax on the consumer and compress tech multiples.
Right.
But this secondary shock directly targets the fundamental growth engine that has been carrying the entire S&P 500 for the last 3 years. Artificial intelligence.
Let's lay out the facts from the sources. On Friday, President Trump ordered the federal government to immediately cease all use of Anthropic's technology.
Just a total ban.
For context, Anthropic is one of the premier leading AI companies in the world. They are the maker of the Claude model, a direct competitor to OpenAI's ChatGPT. And they've been locked in an ongoing, highly contentious standoff with the Department of Defense.
Yep.
Trump posted directly on Truth Social, stating, "I am directing every federal agency in the United States government to immediately cease all use of Anthropic's technology. We don't need it, we don't want it, and will not do business with them again."
We have to unpack the fundamental conflict driving this total ban, because it has massive, sweeping implications for the valuation of the entire AI industry.
It really does.
Anthropic, led by CEO Dario Amodei, had been aggressively attempting to enforce strict ethical guardrails on their AI models. Specifically, the source reporting indicates they wanted to prevent the Department of Defense from using their Claude technology for the mass surveillance of American citizens, or to develop fully autonomous weapon systems.
And the Pentagon was absolutely not having it.
Yeah.
The reporting shows that prior to Trump's public announcement, the DoD actually threatened to invoke the Defense Production Act to force Anthropic's hand.
That's the heavy artillery.
They were prepared to require Anthropic to grant the military full, unrestricted access to its models, or face being officially labeled a supply chain threat to national security.
Which would destroy their enterprise business.
Exactly. Trump's executive order institutes a 6-month phase-down period for all federal agencies currently using the tech. But he also added a severe, explicit warning. He stated that if the company doesn't get their act together and be helpful during this 6-month phase-out, he will use the full power of the presidency to make them comply, citing major civil and criminal consequences.
The ideological clash here is stark, and it's something the market has never had to price in before.
Never.
You have the federal government asserting absolute national security imperatives, and a private venture-backed tech company attempting to dictate terms of service to the U.S. military.
It's a standoff.
An Anthropic spokesperson released a statement saying that the contract language they received from what they pointedly called the Department of War made virtually no progress on preventing Claude's use for mass surveillance or autonomous weapons.
They claimed the new language, which was framed by the government as a compromise, actually included specific legalese that would allow all safeguards to be disregarded at will by military commanders.
And Dario Amodei was blunt in his refusal, saying, "We cannot, in good conscience, accede to their request."
But as we know, the market violently hates a vacuum.
It certainly does.
And where a company like Anthropic steps back due to ideological guardrails, a massive competitor immediately steps in. This is the pivot that every tech investor needs to pay attention to.
Enter Sam Altman.
Also on Thursday evening, OpenAI CEO Sam Altman sent a memo to his staff confirming that OpenAI is already in direct contact with the Pentagon to negotiate the use of their models in classified military settings.
Unbelievable timing.
Now, Altman claims in the memo that they are seeking the exact same guardrails Anthropic wanted, but the optics to the market are crystal clear. OpenAI is moving aggressively to capture the massive multi-billion-dollar government defense contracts that Anthropic is forfeiting.
And this right here is why this matters so deeply for our Monday options trading plan.
Bring it back to the tape.
If we connect this AI standoff back to the broader market, tech was already going to bleed heavily due to the Middle East conflict, as we saw perfectly signaled by Bitcoin's weekend collapse.
Right.
But now, this executive action injects massive, unpredictable government policy risk directly into the AI and enterprise software sectors. Investors fundamentally hate policy risk because it cannot be modeled on a spreadsheet.
You can't run a discounted cash flow analysis on a CEO's conscience or a president's Truth Social post.
You just can't. The market is going to ask immediate, terrifying questions. Will the government come after other AI companies? Will there be widespread Defense Production Act mandates forcing tech companies to hand over proprietary source code?
This uncertainty compounds the expected tech sell-off exponentially. The downside pressure on the NASDAQ is going to be incredibly fierce. So what does this all mean? We have laid out all the puzzle pieces. Operation Epic Fury is an ongoing multi-day daylight offensive. Bitcoin is flashing a massive red warning signal of institutional liquidation.
Safe havens like gold and oil are poised to gap up and explode due to the Strait of Hormuz choke point.
And the entire AI sector is dealing with a massive domestic policy crisis and the threat of the Defense Production Act. Now, it is time to build the actual game plan.
The Theta Fuse strategy.
How do we as retail traders survive and thrive in this environment? How do we trade this panic without getting wiped out?
We synthesize all this weekend data into a cohesive, mechanically sound, actionable option strategy for Monday's open. The absolute core principle you have to internalize right now is the mathematical relationship between the VIX and implied volatility.
Let's break that down.
When geopolitical panic strikes, the VIX spikes violently. When the VIX spikes, options premiums across the board explode. The market makers are not stupid. They see the same news we do. They jack up the prices of all options to protect themselves from the wild, unpredictable price swings they anticipate. This is known as IV expansion.
Which brings us to the single most important rule of the day, and if you take nothing else away from this deep dive, let it be this. Monday is absolutely not the time to buy naked calls.
And it is definitely not the time to buy long puts either.
Oh.
I cannot stress this mechanical reality enough. Let's walk through a hypothetical scenario of what will destroy a retail trader on Monday.
Okay, lay it out.
You log into your brokerage account at 9:35 a.m. You see the NASDAQ is down 3% on the AI policy news and the Middle East strikes. You feel the panic, and you decide to buy out-of-the-money put options on a tech ETF to ride the momentum downward and protect your portfolio.
You are walking directly into a mathematical trap.
You are going to be paying historically high bloated premiums for those puts because the implied volatility is maxed out. Even if the underlying stock continues to drop throughout the week, the moment the geopolitical panic subsides even slightly, maybe a rumor of a ceasefire hits the tape, the VIX will contract.
And that sudden drop in AV is called an IV crush.
It will absolutely destroy the extrinsic value of your option. You will lose massive amounts of capital, even if you are perfectly right about the downward direction of the stock. Buying options when volatility is at its absolute peak is a pure loser's game.
So, if we aren't buying options, we are selling them. That is the entire essence of the Theta Fuse philosophy. We act as the casino, not the gambler pulling the slot machine lever.
We are the insurance company happily selling expensive flood policies to panicking homeowners while the hurricane warning is actively blaring on the TV.
Exactly. Monday is the time to sell cash-secured puts. We want to be the ones collecting those massive panic-inflated premiums from the retail traders who are buying puts out of pure fear.
But there is a very strict, uncompromising discipline to this strategy. You do not sell puts on garbage meme stocks.
No.
You do not sell puts on highly leveraged, unprofitable tech companies that could genuinely face structural ruin from this high-oil, high-risk macro environment.
You sell cash-secured puts exclusively on the blue-chip companies, the fortress balance sheets, the massive index ETFs that you actually want to own and hold long-term.
Let's break that down mechanically so everyone understands. Think about fortress companies like Apple, Microsoft, or even the SPY itself. Let's say a blue-chip stock drops 5% right at the open on Monday morning due to the macro panic.
Because of the VIX spike, the implied volatility on its options chain will be through the roof.
Right. So the strategy is to go down the options chain, pick a strike price that is another 5% or 10% below the currently panicked or discounted price, and you sell a put expiring in 30 to 45 days.
Why 30 to 45 days?
Because that is the sweet spot where theta decay. The daily loss of the option's value as it approaches expiration begins to accelerate in your favor as the seller. You sell that put, and you collect a massive inflated cash premium up front directly into your account.
Let's look at the two possible outcomes of that trade, because both are favorable if you follow the discipline.
Outcome 1.
The geopolitical panic subsides over the next month, and the stock stays above your chosen strike price. The option expires worthless, and you keep 100% of that massive premium as pure profit.
Then outcome 2.
The conflict worsens, the stock continues to crash, and it drops below your strike price at expiration. You're assigned the shares.
But remember your parameters. You picked a strike price that was already heavily discounted from an already panicked Monday market price on a blue chip company you explicitly wanted to own anyway.
You're essentially getting paid a high premium to set a limit buy order at a massive discount.
In a historically high VIX environment, selling cash-secured puts on assets you want to own is mathematically the highest probability strategy available.
But while we are executing these high-level option strategies, we also have to address the other side of your financial life. We are aggressive volatility traders in our options accounts, but we are stoic, disciplined investors in our core portfolios.
This brings us to the long-term discipline that separates the professionals from the amateurs.
You must maintain a crucial psychological separation of your accounts.
This is exactly where psychology destroys amateur traders. While we are going to actively and aggressively trade the IV spikes in our options accounts to generate cash flow, you must absolutely not touch your core long-term portfolios.
Do not log into your 401k, your IRA, or your TFSA on Monday morning and liquidate your broad market index funds just because the news headlines are terrifying.
I want to reiterate that because it goes against every human instinct. Do not panic sell your long-term assets.
The philosophy we preach here at Theta Fuse is that geopolitical panic drops, these sudden, violent repricings of global risk, are the exact mathematical reason why you maintain a systematic, always buying strategy in your core accounts.
Precisely. If you have automated bi-weekly buys set up in your TFSA or your 401k to purchase broad market ETFs, let them run. Do not pause them. Do not try to time the absolute bottom of a war.
When the market drops 5% or 8% on war fears and AI policy chaos, your automated system is just quietly buying more shares for the exact same amount of money.
You are averaging down passively, without emotion. History shows us time and time again that markets eventually digest geopolitical shocks, the supply chains reroute, the panic subsides, and the broad market recovers.
Let your automated buys trigger at lower, discounted prices while the rest of the market acts on pure, unadulterated emotion. Keep the adrenaline and the active strategy in your options account, and keep the ice-cold, robotic discipline in your retirement accounts.
Okay, we have covered a massive amount of ground today.
We really have. We've synthesized the military realities of Operation Epic Fury and the implications of a multi-day conflict. We've looked at the Bitcoin canary in the coal mine, signaling a massive tech flush.
We've mapped out the safe haven energy plays and the logistical nightmare at the Strait of Hormuz.
We've analyzed the Anthropic AI curveball and the injection of government policy risk into the software sector. And we've mapped out a definitive, mathematically sound options strategy to capitalize on the incoming IV crush by selling cash-secured puts on blue chips.
The board is set, the data is clear, and the pieces are moving rapidly. The weekend is strictly for research, parsing the rhetoric, and planning your strikes. Monday is for executing those plans without a shred of emotion.
We know the VIX is going to gap up, we know the options premiums will be historically bloated, and we know exactly where we are going to deploy our capital to sell premium to the panicking masses.
And before we wrap up, I want to leave you with one final thought to mull over before the bell rings, looking at the long-term implications of this Anthropic ban.
Go ahead.
If OpenAI successively captures these massive Pentagon contracts because Anthropic refused them on ethical grounds, we aren't just looking at a short-term tech rotation. We might be witnessing the birth of a monopoly where a single AI company becomes inextricably woven into the fabric of the U.S. military-industrial complex.
That is a massive thought.
How does the market eventually value an AI company that essentially functions as a branch of the Defense Department? That is a fundamental shift in tech valuations that will play out long after this current geopolitical panic subsides.
Absolutely. But right now, it's time for you to weigh in on the immediate future. We have an overarching engagement question for you, the listener. We have 48 hours until the opening bell rings. Look at the data we just presented and tell us in the comments, yes or no. Will the market crash on Monday, or is this strike already priced in? Drop your answer below. We want to see where the community sentiment is sitting right now before the institutional algorithms take over.
As always, we talk options and strategies on Theta Fuse, but this is for educational purposes only. We are not your financial advisors. Trade your own plan and stay safe out there.